What if the latest U.S. jobs report is either proof the economy is strong or proof that the headline looks better than the reality? Today, we're breaking down the January jobs numbers, what they really mean, why some people are celebrating, and why others are raising serious questions. But before we jump in, make sure you like this video, share it, and subscribe to Mano Invest so you stay ahead of what's actually happening in the economy. All right, let's get into it. The government says 130,000 jobs were added in January. Unemployment dropped from 4.4% to 4.3%, and wages up 3.7% year over year. On paper, that looks strong. Job growth, low unemployment, rising pay. If you just read the headline, you'd think everything is firing on all cylinders. But numbers always deserve a second look. Here's where the jobs actually moved. Government employment? Down overall. Federal and state jobs were cut. Local governments added some, but not enough to offset the losses. Financial services lost jobs. Information sector? Down. Transportation and warehousing? Also down. But healthcare added nearly 82,000 jobs. Construction added 33,000. Manufacturing added 5,000, which actually beat expectations. So yes, jobs were added, but not all parts of the economy are expanding equally, and that matters. Now let's talk about wages. The report says wages are rising 3.7%. Inflation, officially, is about 2.7%. So technically, wages are outpacing inflation. But here's the question. Do you feel like your cost of living is only up 2.7%? Groceries, insurance, rent, utilities? For many people, it feels higher. Some alternative estimates suggest inflation may be closer to 5 or 6%. If that's true, then wage growth isn't keeping up. And that could explain why the data looks strong, but people don't feel strong. Now here's something important. The government revised last year's job numbers. Originally, 2025 showed 584,000 jobs added. Now, that number has been revised down to 181,000. That's a 69% reduction. Revisions happen, but when they're that large, people start asking questions. Are early reports overly optimistic? Are adjustments missing business slowdowns? It doesn't prove manipulation, but it does explain skepticism. Now let's connect this to interest rates. The Federal Reserve cuts rates when the economy is weak. If the labor market is strong, they have less reason to cut. Before this jobs report, markets believed there was about a 22% chance of a rate cut at the next Fed meeting. After this report, that probability dropped below 6%. Why? Because if everything looks solid, there's nothing to rescue. Now zoom out. The U.S. government carries over $38 trillion in debt. Interest payments alone are costing hundreds of billions of dollars already this fiscal year. Interest expense is now rivaling major spending categories. Lower rates would reduce borrowing costs, but cutting rates too aggressively could fuel inflation again. So the Fed is stuck balancing economic growth, inflation risk, and government debt pressure. So what's the real story? The data shows job growth, low unemployment, rising wages. But we also see major downward revisions, sector weaknesses, massive federal deficits, and shrinking odds of interest rate cuts. That's why the economy feels confusing. The data says one thing, people's experience sometimes says another. The truth? It's probably somewhere in between. Now, I want to hear from you. Do you believe the labor market is truly strong right now? Or do you think the numbers don't tell the full story? Drop your thoughts in the comments. And if this breakdown helped you understand what's really happening, make sure you like this video, share it, and subscribe to Mano Invest. Thanks for watching. I'll see you in the next one.